How low will the gold to silver ratio go? Hi everyone and welcome to Ainslie Insights, brought to you by Ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth and the Gold and Silver Standard. Be sure to have a look. Today, welcome back, Drew. He's been talking to us about this for quite a while, but it's really interesting. There's a lot I'm going to dig into today because we had a very, I'll call it a feisty meeting yesterday where we were just debating what's going on in the markets at the moment. So I think I want to dig into a whole lot of stuff with you today to sort of catch everyone up to what we're currently thinking, because there was a lot going on over the last sort of 24 hours. How are you going today, Drew?
Good, Chris. How are you?
Yeah, not too bad. Still recovering from our conversation yesterday, actually. It was a good one because, I mean, I know the title's there about the gold-silver ratio, and that was certainly something we discussed, but there's so much more to it. We were sort of looking and going, well, what is actually going on here? Are we at a point where we need to get a little bit more bearish? Because we've been discussing for quite some time about the liquidity index and the fact that that seems to have peaked, or at least liquidity's changing, how that's coming about. You've been looking at some specifics that really pulled me up a bit from my bearish view to say, well, you've got to be a bit more bullish, but then I've got to reconcile that with your land cycle where you've been telling us there's some real issues there, some real risks. Lots to cover, but let's start off with bonds because I know that's an area that you do like to sort of touch on. When we're talking about what's going on there, is that giving us any clues? What are you looking at?
100%. You've always got to keep your eye on the bond market. It is the largest and most important market in finance. So you can always get clues from what's happening there. We'll certainly touch on that in a second. In terms of bearishness versus bullishness, I do think, like you always say, does come down to your time frame. So if you're looking at the immediate term, things are looking relatively uncertain, I would say, for the bears. You're starting to see the DXY break structure start to roll over. We are in that final stage of the land cycle, however. And what that means is while you do get increased risk appetite and a bit of a flood of liquidity toward the final stage, it's certainly not a time to be complacent if you're looking at the mid to long-term cycle, because you will get to a point where the cycle peaks and it's really not the time to be in risk assets. So it's interesting because the final stage, when you see that liquidity and risk appetite increase, you see risk assets outperform. And so they fall into favor a little bit more. But that's still the last place you want to be at the peak of the cycle. So it's either be quite nimble, or if you're looking at a longer term perspective, which I think most people will do, just averaging into assets that will do really well, not only in this final stage, but also in the next stage, which is beyond the crash, in the recovery phase, assets that outperform throughout all of these, where they don't fall back as much in the crash and they recover the fastest and the strongest in the recovery phase, and then continue putting on higher highs, an extended bull run cycle, while other assets struggle. So gold and silver is basically your assets of choice in that environment where you can average throughout the final stage of the peak, even during the crash and during the recovery, and you're generally going to be okay. However, in the short term, there's a lot to have a look at in terms of the dollar and the bond markets. The US 10-year yields have lost support and they're struggling to get back about support, but we'll look at a few charts to really put this in context. And
because I just want to, as you're sort of getting those charts together, I want to just highlight where our point of difference was yesterday and where you ultimately dragged me around a little bit on this, because it's exactly what you just said. It was time frame. And I'm going, look, there is lots of evidence to suggest we have some problems ahead, right? And both of us agree on that because we've talked about that so much in this platform and in other platforms. But when we looked at it, you were sort of saying, yes, that is still coming, but not right now. And what's really fascinating about this for me is that I was taking the view that was a somewhat safer view to go, well, a crash is coming at some point, so we may as well just sit off to the sideline now, because I don't get egg on my face in that environment because I'll be right eventually. Whereas you were taking a somewhat bolder view, in my opinion, where you were saying, well, yeah, that can be correct, but based on everything we're looking at right now, that's not where we are at this particular moment. And I'd love for you to start with that 10-year bond yield, because that's one that I'm saying part of the problem that will emerge is some sort of tantrum in the bond market. So I'm expecting a spike in that, and I can say, yeah, I'll be right, but I'll be right eventually. But you're saying it's not there right now. It's not happening at this moment.
100%. So the spike will be reflected in the move index as well. So you'll see bond market volatility shoot up, and you'll see the yields spike up, so the collateral values fall off, and that's really going to be terrible for global liquidity. When you got low collateral values, you can't raise as much debt on a lower value foundation for the debt. So the US bonds essentially form the foundation of the global liquidity or the debt in the global financial system as the collateral. And the volatility is really important because the lower the volatility, the more debt you can raise on it, just because it's lower risk being a low volatile asset. So the move index has been trending down for a while. Now, leading into the previous land cycle, we saw the move index get down to the 50s region. And if you can see my cursor on the screen, this is where we are right now. It's a nice sustained downtrend. This was just the 2021 to 2022 downtrend in the previous liquidity cycle. So I don't have this going as far back as the previous land cycle, but we saw a very similar look leading into the peak of the previous land cycle, which was the global financial crisis. So leading into the end of 2007, you saw the move index basically trend down nice and steady all the way down to the 50s. What you saw with the bond market, however, was bond yields essentially stubbornly remaining elevated. And a lot of people have been talking about a rate cutting cycle and expecting this to just continue on, into the next couple of years. And there's a strong argument to be made that we're not really going to get the cutting cycle that everyone's expecting. So bond yields and interest rates could likely stay elevated. Let's have a quick look at the US 10-year yield zoomed in, and we can get an idea of where we are today. But a tantrum in the bond market would be a very educated guess as to what causes the peak of this land cycle. The land cycle will always peak with some type of systemic instability, and you see the tide essentially pull out. And in that situation, you get instability in banks and hedge funds, and you essentially see who's swimming naked. Now, looking at the current situation in the US bond market, that certainly would be my guess as to what causes this, or what leads to that sudden drain of liquidity, if you will, from the global financial system. Now, in terms of timing it, right, we've been on the lookout for this for a year or so, a bit over a year. The winner's curse phase historically on average lasts about 2 years. We're really getting to that final phase, and I wouldn't be surprised to see it sometime in 2026. So if we do get a rally in risk, how high it goes, how long it lasts, it's, you're really, like you said, it's a bit of a bolder place to be, but it depends on your time frame and your risk appetite. For most investors, they are probably going to be, in the camp of somewhere in between your stance and my stance, where they'll have a little bit in risk and then they're averaging out into precious metals, which, to be fair, is sort of where we would agree that it's not the worst idea to start taking a little bit of risk off the table. But that the land cycle has peaked is probably a little bit premature, because you do get lags and leads in the liquidity cycle. And while we do feel like the macro liquidity cycle has peaked, there could be that final blow off top in liquidity as well, just in that final stage. Having a look here at the US 10-year yields today and where we are, I mean, it's in a little bit of no man's land, right? So we've got this wedge, and it's broken down from this wedge. It's lost support. My view is that the yields might roll over here, but I'm not 100% convinced with that. If we do see a tantrum in the bond market eventually, when it does occur, you could see the yields maybe roll over for a little bit, get a bit more of that complacency and liquidity in the market, and then see that sudden spike where you'd see then the move index spike as well. So the bond market would be something to keep an eye on in 2026. I would not be surprised at all with the bond market tantrum in 2026. And that, to me, would mark the peak of the land cycle. We'd see a strong pullback in stocks and risk assets. We'd see a very short-term pullback in gold and silver. And bringing it back to what we're talking about, which is the gold to silver ratio, this is where you see that final spike in the gold to silver ratio before it really falls off in a much more notable way. So it's down below 70 now. And, we did always say that we'd see a steady downtrend in the GSR leading into the peak of the land cycle and the liquidity cycle. And we're seeing that now. How much lower it goes is a very short-term thing. Like, if we see this complacency and risk appetite increase further, yes, the GSR will trend down further in the short term. But when we get that bond market tantrum, or whatever the crisis is in 2026, you will see that spike in the GSR. And it's after that spike that the massive opportunity in silver really lies, which is, you see it fall off in a much more notable way after the land cycle peaks, which we're getting closer to every day.
Can you just keep that chart there for a second? Because I just want to dig into that slightly more on the breakdown, because that is also part of the difficulty in our conversation around it yesterday. When we look at it, you go, like, the breakdown there doesn't make any logical sense to me longer term, which is why I'm confident that it will be exactly, as you said, a very highly educated guess that it will be the breakdown in the bond, some sort of bond tantrum that will cause the problem. Because what that actually means for people who go, bond markets, I don't understand. It's saying that the interest rate required on the debt is falling, and that doesn't really make sense when there's more debt available and more uncertainty, and they're pumping more, trying to push more debt into the system. Ultimately, what should happen in that environment, and we're all probably pretty confident happens longer term, is rates go up, because people go, we don't want that debt anymore, so you've got to offer a higher rate for them to absorb all of that extra debt that's coming onto the sheet. So longer term, logically, it makes sense, but that's the difference here. You're saying that may be true, but it can also be true that right now the market doesn't care about that. Like, the market might care about that a lot in the future, maybe not that far in the future, but today it doesn't care.
Absolutely spot on. Well said. And with the bond market, there's so much bond market manipulation as well that can happen in the short term. And manipulation, only lasts for so long before the laws of nature take over. So there might be a bit of yield curve control and things like that in the short term. But if you look at it long term, this manipulation actually makes the whole situation a lot worse. And we've had the US bonds downgraded now by every major credit rating agency. So it is a higher risk asset to hold. It makes sense that the interest or the yield on a higher risk asset is higher. So bond yields going lower on a long-term scale does make absolutely no sense if you look at it from a fundamental analysis point of view. From a technical analysis point of view, again, the bond yields has a way of running everyone's stops and going in the opposite direction. So I'm not 100% convinced that we roll over here, but I would not be surprised to just see a short-term pullback just for that final phase of the liquidity cycle. Seeing the DXY roll over simultaneously as well would make a lot of sense. And I'll actually just, since we're talking about the DXY, bring that up as well to see where we are, because
that's the next part of this puzzle for me. The bond market is huge, a huge component of global liquidity, but probably nothing is bigger than the dollar. And you've been calling a breakdown in that quite a bit recently, like you've been showing where that break in structure has occurred. And I've been a little bit skeptical because I sort of went, well, I don't see it necessarily. I think it's sort of just sitting sideways. But I'd love for you to talk us through your view on that, because it would align.
100%. So having a look at a slightly more zoomed in picture for the DXY before we zoom out, this is what we noted earlier this week. So, a couple of days ago, we had the DXY essentially fail its daily cycle. It put in a left translated daily cycle and it broke structure. So you've got daily closes below that low. You can see higher highs and higher lows the whole way up. And then you see a break in structure below that with a failed left translated daily cycle. So the moment that's on your radar, you know that it's showing weakness. It's an early sign of weakness, and there's a fairly high chance now that we see a bit of continued downside. Looking at where we are today with the DXY, that has continued to play through. And just let's see if this is the right chart. Yep, that's the one. So you can see here, this is what we noticed. We did get a little bit of a counter trend rally, and since then it's continued further down. Now that counter trend rally peak has given us a trend line as well. So as we've got a left translated failed daily cycle here with a break below these lows, as long as we stay below this yellow trend line, I'm not too concerned. I think the DXY downtrend is relatively intact. Once we break this trend line, I'll start sort of paying a bit closer attention to it. And, my base case on the DXY has been a downtrend for a while now from a macro point of view, just because the final phase of the land cycle, you do see the DXY fall off a cliff. And this is a chart that we made, I think it was early this year, looking at the DXY overlaid on the 18.6-year land cycle. So we've got the different phases of the land cycle marked here. You've got the final phases of the land cycle where you see your blow off top marked in green. So these are overlaid exactly over the land markets, overlaid exactly over, the stock markets and where we saw the peaks for the previous land cycles come in. And you can see here, just like clockwork, every time the DXY falls off a cliff in those final phases. We made this chart a while back when the DXY was all the way up here. I've lost that one. All the way up here at, it was at like 140, 104. And, it's fallen off a fair bit since then. Let me just bring that chart back up. It's fallen off a fair bit since then. And, we've lost that one. That's all right. So we've fallen off a fair bit since then, right? And since then, we've then consolidated. And, to look at it from a more macro point of view, it would make sense that downtrend continues. And looking at the DXY having failed its daily cycle now, it would make sense that downtrend continues for the final blow off. So really quickly, to have a look at a few indicators of where we are in terms of the risk appetite, in terms of the gold and silver ratio, and just where we are with the land markets. We'll quickly look at that, and then we'll bring it back to the gold to silver ratio for the base case expectation. So the land markets we've been looking at for a while in terms of this chart here that's helped us track it. Now, we can see here, this was the Trump tariff spill. This was a recovery. We were very concerned here about a lower high. We were tracking this. When it fell back down to its 50% level, we said, look, we should get a strong bounce from this level. We did not. And when we got this sort of double bottom, we said, okay, this is, kind of getting to a bit of a knife's edge, a little bit tenuous. We saw a break below that 50%. And we said, okay, well, once we start closing multiple weeks here, this uptrend is now in a position of weakness, and this could be a high, a lower high. We'd be looking at this for a lower low, for a confirmed downtrend in the land markets, while the S&P was putting its own blow-off rally in progress. The S&P had a spill from the Trump tariff scare. It then put in a higher high and has continued well and truly on its way, while the land markets are kind of struggling here. And that is a telltale sign for the final phase of the land cycle. Once you get the confirmed downtrend in the land cycle and you've got the S&P blowing off, you've not got a lot of time left on the table. So, land markets are still pretty tenuous. You haven't broken this high yet. You're getting a, relatively kind of anemic bounce off the 50%. Like this could very well roll over here and we could break this. Once we break this lows, it's really high alert. You've got to start getting risk off the table. So that divergence between land and stocks, which we've looked at quite a few times, which is well and truly in play right now. Stock markets have continued on to put in new high after new high, and the land markets have put in this potential lower high, struggling to get above this 50%, might roll over here. So we've got that divergence building. The other
and I just want to say on that as well, that lethargic, not quite the bounce we wanted, is part of my concern as well, and that's why it's so difficult at the moment, because if we'd gotten, and this isn't just in the land markets, it's also in Bitcoin, for example, that we were looking at. If we'd gotten a solid bounce that you would usually expect there, it would make it clear. When you get this lethargic sort of limp bounce that happened, there's no clarity from that. So if anything, it makes you sort of think that there is still more downside to come, but to the point of you can't ignore the trend that's sitting in front of you, because still at the moment it's sitting above that 50 line, for example.
Exactly right. So, you technically don't have a lower low. And so it's in no man's land.
Yeah.
Which is why it's on a knife's edge. And it's sort of similar with a risk asset like Bitcoin as well, because we're on a sort of weekly cycle low, and those things can, take some time to play out. We haven't really broken structure in a significant way. So if this started closing multiple weeks here, if this started closing below here, then you've got, clear signal there. And the problem with these anemic bounces, it certainly is an early warning sign, but markets can change. So, once you have those early warning signs, like the concerns are very valid, and it is important to pay close attention. And it's a very uncomfortable situation to be watching it closely, but not taking any action, because, while you're watching it closely, you are waiting for that final confirmation. And that's where that sort of discomfort lies, because, and if it was easy, everyone would do it. But, the whole thing with this is just sitting in discomfort perpetually and not, trying to sit on your hands and not do too much. And with, with the land markets, again, like you said, it's an anemic bounce, and, we may just see a rollover here. But it's yet to be seen. It's yet to be confirmed. It's something that we just got to pay attention to. And this is a chart that we've been watching for so long. This is This is a weekly, right? So how many weeks? That was like April. So this is something that's, you spend a year just looking at it every now and then and tracking it, and you don't have an answer for over a year. And so it
Yeah.
could be another 6 months before you even get an answer. So a lot of these are very slow moving situations. But just to have a quick look at risk appetite as well, because I think that's an important one. The Russell 2000 is, firing off. And that's something that we've been tracking since the Trump tariff spill as well. This is one of our core indicators to sort of measure risk appetite. Now, this is sort of the base of the current liquidity cycle, starting here. Decent move up. This is the Trump tariff spill, right? So this was concerning because it broke below the 50% levels. Smaller markets tend to have more volatility, so there's got to be a little bit more wiggle room for, indicators and how you use structure and things like that. But this is still very concerning. We saw this, we got back above it, and this is where like, okay, it's starting to look okay here. We were tracking this for risk appetite to this sort of point here and saying, once it broke to new highs, it gave us a little bit more confidence that this market is looking strong and we should see that final liquidity injection, that final blow off top. You do see higher risk appetite in the final phase of the land cycle. And what that means is smaller markets tend to do really well because it's more speculative. And what we can see here is, this pulled back a little bit and we've broken to solid new highs. Small markets are doing well. Again, it shows a little bit more complacency and risk appetite. We're seeing the move index trend down. We're seeing the bond yield stay stubbornly elevated. We're seeing the DXY show weakness. And we're seeing the land markets potentially diverging from stocks. So all of these signals we've been tracking for a while, but it just shows that they are progressing as expected. And each month that passes, the more they progress as expected, the further we are along the cycle and the less time we have in terms of some sort of serious crash or correction or systemic issue in the financial system that will see bond market volatility spike, that will see the VIX spike, they'll see stocks, really suffer, risk assets really suffer. And this is where we come back to the gold to silver ratio and precious metals, because precious metals pull back a little bit for a short period and then continue on strong rallies. And it's after the crash that silver really significantly outperforms gold. And the gold to silver ratio falls off in a very strong way. Now, it's also interesting that, gold and silver have their own cycles, 8-year cycles. It started in 2022. 2026 is the exact half cycle low, the half cycle point for gold and silver. And coming out of 2026, they'd be in the second half of that 8-year cycle. And it would make sense for silver to outperform gold in the second half of that 8-year cycle anyway. And looking at the land cycle peaking in 2026, silver tends to outperform gold after the peak of the land cycle as well. So there's further confluence there for the silver investors that, moving out of 2026, you should see a very strong performance of silver relative to gold and certainly relative to the dollar. And, we can show that on this chart here because this is something that we've shown quite often, but this just puts it all in context for where things end up. So this is the global financial crisis. You can see land falling off first in blue. You can see stocks continuing on. This is that divergence between land and stocks where land's putting in a downtrend and stocks continue up. This was the peak, right? So this is where you had the 2007, late 2007, October 2007 was here. And then you saw this. There's like 60%, more than half your retirement portfolio, more than half all the pension funds experienced this over a couple of months, where the stock market just fell off. Land and stock, found their lows at the same time. So cycles are measured from low to low, not peak to peak. So you get peaks at different times, but lows tend to come in at the same time. And look at gold and silver. They continued on their uptrends. They actually continued on their uptrends a little bit further than stocks. The stocks started rolling over before these guys, gold and silver, peaked. Gold and silver put in very short pullbacks during this time. And that's because when everything is pulling back, when people are in trouble, they sell what they can to cover themselves. But look at the recovery. Gold and silver, gold especially, immediately bounced back here. And while the stock market was still putting in its lows, still at the lows, gold was already back at its all-time highs. So you had stocks peak and fall off, gold continue for a little bit further, just a quick dip in recovery while the stocks are still at the bottom. And in green, we've got the GSR. So this is sort of where we are today. We're looking at that divergence potentially setting up for land and stocks, the final stage of the cycle, the Russell 2000s blowing off, the DXY might be rolling over. And we've seen the gold to silver ratio trend down this year. And we've been saying that that was the expectation, but don't get too excited because there will be that final spike. And don't lose hope when you see that final spike for the gold to silver ratio, because when this happens and everyone's selling everything, gold outperforms basically any other investment because it's a flight to safety and it's a higher market cap. So that final spike happens during the crash. And then it's in this recovery phase where stocks are struggling to recover for years. Let's say the stocks are here, they're way off their all-time highs. At that point, you've got gold here, which is already at a massively new high. And you've got the gold to silver ratio then falling off a cliff that was 70 to about 35. And I believe this time will fall lower. And then you've got silver putting in this crazy vertical rally over multiple years. And so you've got gold and silver putting in strong rallies, the gold to silver ratio falling off a cliff. So this is in line with expectations, just another indicator that we're getting to the peak of the land cycle, that the GSR is falling off. When you get that crash, which could be sometime in 2026, you see a quick spike and then the GSR falls off massively. Gold and silver have quick dips and just continue on, basically vertical moves from that point. So for long-term investors, whether you're DCAing here along the whole way, it doesn't really matter. You can just average in. For investors that want to be a bit more nimble, that peak, that low in silver is a great opportunity. And this is where you want to be averaging out of stocks and land for that peak of that cycle.
Look, I think that was an excellent conversation. It really caught so much of what we were talking about that is really important. You mentioned before about it being uncomfortable, and I think that's a great way to sort of describe it. It is uncomfortable during these periods because we know we're close, but if you act too early, I mean, it doesn't really hurt to act too early, but at the same time, you're leaving stuff on the table, and when you can wait that little bit longer because the confluence isn't there that you're looking for. So all of that makes a whole lot of sense, and I think we're going to be watching closely. It's going to be something that we're going to have to do well into next year to continue to watch those and really get the confirmation. But it's important to keep coming back to your framework there to sort of steady the ship through these times. So we really value that. Look, we said at the start, how low can silver go? I'm going to ask you one yes or no question for the audience. Can we get the GSR realistically below 50 before that spike?
I wouldn't bet the farm on the GSR dropping below 50, below the crash, below the spike. I think it's at a decent point now. And, it may or may not. You're not going to...
Look, this was about being uncomfortable, Groove, and you clearly were. So I actually achieved my objective on that question.
I can say with a very high level of confidence that the GSR will fall below 50 after the crash.
Oh, I see. He's done a politician's answer on that one. Someday it will. So, yeah. Look, highly valuable. It's been a highly valuable couple of days of discussions on this stuff, but really, hopefully people appreciated us sort of sharing the discomfort amongst that, because that's all part of the process. Really value your time, really value your work. Thanks for that today, Drew.
Thanks so much, Chris. Good to talk to you.
Good to talk to you. Thank you, everyone, for watching. We'll chat again soon.